Imagine building a company so massive that its collapse could shake the world's second-largest economy. That's exactly what happened with China Evergrande Group. In September 2021, this real estate giant, once worth over $300 billion, defaulted on its debt payments, sending shockwaves through global markets and threatening to topple China's entire property sector. But here's the crazy part. Evergrande wasn't just building apartments. They were running theme parks, making electric cars, and even had a professional soccer team. So how did a company that controlled 2.3% of China's entire GDP go from unstoppable growth machine to economic disaster? Today, we're diving deep into the numbers behind one of the biggest corporate collapses in history and why it matters for your wallet, whether you live in Beijing or Brooklyn. Let's start with how Evergrande became this monster in the first place. Founded in 1996 by Xu Jiayin, Evergrande began as just another Chinese property developer. But Xu had bigger dreams, and he built his empire on one simple but dangerous strategy: debt-fueled expansion. Here's how the numbers looked during their explosive growth phase. In 2009, Evergrande's total assets were worth about $8 billion. Fast forward to 2020, and they had exploded to $355 billion. That's a 4,300% increase in just 11 years. To put that in perspective, that's like turning $1,000 into $43,000 in a decade. But here's where it gets interesting from a financial standpoint. Evergrande wasn't just growing through smart business decisions. They were borrowing massive amounts of money. By 2021, their total debt reached a staggering $300 billion. That's more than the GDP of countries like Finland or Chile. The company was completing projects at an incredible pace. In 2020 alone, they delivered 406,000 residential units across China. They had over 1,300 projects spanning more than 280 cities. Think about that scale. If Evergrande was a country, it would have been one of the world's largest real estate markets all by itself. Their revenue numbers were equally impressive. In 2020, Evergrande generated $110 billion in sales, making it not just China's second-largest property developer, but one of the biggest real estate companies on the planet. The company employed over 200,000 people directly and supported millions more jobs through contractors and suppliers. But remember that debt number, $300 billion, because that's where this story takes a very dark turn. Now let's talk about how Evergrande's business model was essentially a financial time bomb waiting to explode. And to understand this, we need to look at something called the pre-sale model that dominates Chinese real estate. Here's how it worked. Evergrande would sell apartments to customers before they were even built. Buyers would put down deposits, sometimes their entire life savings, for homes that existed only on paper. The company would then use this money to fund construction and, crucially, to buy more land for future projects. The numbers here are mind-blowing. By 2021, Evergrande had collected approximately $200 billion in pre-sale deposits from over 1.5 million customers. That's roughly $133,000 per customer on average, representing entire family fortunes in many cases. This created what economists call a Ponzi-like structure. Evergrande needed constant new sales to fund existing projects and pay off previous debts. As long as China's property market kept booming and people kept buying, the system worked. But it was incredibly fragile. Let's break down their debt structure because this is where the real financial disaster was brewing. Of that $300 billion in total debt, about $88 billion was owed to banks and other financial institutions. Another $155 billion was in the form of trade payables, money owed to contractors, suppliers, and other businesses. The remaining amount included those customer deposits and various other obligations. Here's the kicker. Evergrande's debt-to-equity ratio had ballooned to over 150%. In simple terms, for every dollar of actual value the company owned, they owed $1.50 to someone else. Most healthy companies aim to keep this ratio below 60%. Their interest expenses alone were crushing them. In 2020, Evergrande paid $15 billion just in interest on their debts. To put that in perspective, that's more than the annual military budget of countries like Sweden or Switzerland. Before we dive into the collapse itself, if you're finding these financial breakdowns helpful, make sure to subscribe and hit that notification bell. We break down complex economic stories like this every week, always focusing on the numbers that matter to your financial future. Also, let me know in the comments, Were you following the Evergrande story when it was happening, or is this your first deep dive into the numbers? Now here's where the Chinese government inadvertently lit the fuse on this debt bomb. In August 2020, Chinese regulators introduced what they called the Three Red Lines policy, a set of financial restrictions designed to cool down the overheated real estate sector. These three rules were simple but deadly for companies like Evergrande. First, a company's debt-to-cash ratio couldn't exceed 100%. Second, their net debt-to-equity ratio had to stay below 100%. Third, their debt-to-asset ratio couldn't go above 70%. Let's see how Evergrande measured against these standards. Their debt-to-cash ratio was sitting at around 240%, more than double the allowed limit. Their net debt-to-equity ratio was approximately 159%, way above the 100% threshold. And their debt-to-asset ratio was roughly 81%, significantly higher than the 70% cap. Evergrande violated all three red lines simultaneously. This meant they were completely cut off from new borrowing, and they had until 2023 to get their finances in order. But here's the problem. They needed constant access to new credit to keep their business model functioning. The policy had immediate effects on Evergrande's cash flow. In the first half of 2021, their sales dropped by 24% compared to the same period in 2020. New project launches fell by 38%. Without fresh sales and with borrowing restrictions in place, Evergrande's cash position became critical. By mid-2021, credit rating agencies were already sounding alarms. Fitch downgraded Evergrande's credit rating to CC, indicating that default was highly likely. Moody's followed suit, cutting their rating to CA, just one notch above their lowest possible rating. The writing was on the wall, and the financial markets could see it coming from miles away. September 2021 marked the beginning of the end. On September 23rd, Evergrande failed to make an $83.5 million interest payment on its US dollar bonds. This wasn't just any missed payment. It was the moment that $300 billion worth of debt officially went into default. But the real panic started when the human cost became clear. Remember those 1.5 million customers who had paid deposits for unfinished homes? Many of them gathered outside Evergrande's offices, demanding their money back. Videos circulated showing protesters holding signs reading, "Return our hard-earned money," and "Evergrande, pay your debts." The financial contagion spread quickly. Evergrande's stock price, which had peaked at about $4 per share in 2017, fell to under 20 cents by late 2021, a 95% collapse in value. The company lost over $240 billion in market capitalization, wiping out the savings of countless retail investors. Here's where the numbers get really scary for the broader Chinese economy. Evergrande's collapse triggered a domino effect across China's property sector, which accounts for roughly 25% of the country's GDP. Other major developers like Country Garden and Sunac China saw their stock prices plummet by 60 to 80%. The ripple effects hit the banking sector hard. Chinese banks had approximately $88 billion in direct exposure to Evergrande, but the indirect exposure through the broader property market was estimated at over $2 trillion. That's roughly 13% of China's entire banking system. Construction activity across China slowed dramatically. In 2022, new housing starts fell by 39% compared to 2021. Property investment dropped by 10%, and home prices in major cities declined for the first time in over a decade. The human impact was devastating. An estimated 1.6 million apartments that had been pre-sold by Evergrande remained unfinished. Construction workers went unpaid. The company owed approximately $25 billion in wages and supplier payments. Entire supply chains that depended on Evergrande ground to a halt. Now, you might be thinking, this is a Chinese company, so why should I care if I live in the US, Europe, or anywhere else? Well, the Evergrande collapse had global implications that you probably felt in your investment portfolio, even if you didn't realize it. First, let's talk about the direct financial exposure. International investors held about $20 billion worth of Evergrande's offshore bonds. Major global investment funds, including BlackRock and UBS, had significant positions that became essentially worthless overnight. The commodity markets felt immediate impact. Evergrande was one of the world's largest consumers of steel, cement, and copper. Their collapse contributed to a 20% drop in iron ore prices and a 15% decline in copper prices in late 2021. If you owned commodities or commodity stocks, you felt this. Global stock markets experienced significant volatility. The S&P 500 dropped 2% in a single day when Evergrande's default became official. European markets fell even harder, with the DAX losing 2.3% and the FTSE dropping 1.9%. Asian markets outside China were hit worst, with Hong Kong's Hang Seng Index falling over 3%. But the biggest concern was contagion risk. Economists worried that Evergrande could trigger a Lehman Brothers moment for China, a financial crisis that could spread globally. The company's debt was so massive that its collapse could destabilize China's entire financial system, and China represents about 18% of the global economy. Currency markets also reacted strongly. The Chinese yuan weakened by 3% against the US dollar in the weeks following the default, while safe haven currencies like the Japanese yen and Swiss franc strengthened as investors sought stability. Perhaps most importantly for everyday investors, the Evergrande crisis highlighted the risks of China's debt-driven growth model. It forced global investors to reassess their exposure to Chinese markets and led to a broader pullback from Chinese assets that continued well into 2022 and 2023. So what can we learn from this $300 billion disaster? First, the Evergrande collapse perfectly illustrates what happens when debt-fueled growth meets regulatory reality. The company's business model was fundamentally unsustainable. You simply can't borrow your way to prosperity indefinitely. From an investment perspective, Evergrande teaches us about the importance of looking beyond revenue growth to understand a company's true financial health. While Evergrande's sales numbers looked impressive, their balance sheet was a disaster waiting to happen. The Chinese government's response also provides important lessons. Rather than bailing out Evergrande, regulators focused on protecting homebuyers and maintaining financial stability. They established a fund to help complete unfinished projects and implemented stricter oversight of property developers. As of today, Evergrande's liquidation process continues. The company was officially ordered to liquidate by a Hong Kong court in January 2024, though the process will likely take years to complete. Founder Xu Jiayin was arrested on suspicion of crimes, and investigators are still unraveling the full extent of the company's financial irregularities. The broader Chinese property market remains depressed. Total sales are still down about 25% from their 2021 peak, and many other developers continue struggling with their own debt burdens. For global investors, Evergrande serves as a reminder that emerging market investments come with unique risks. The combination of rapid growth, government policy changes, and different regulatory frameworks can create perfect storms that destroy even the largest companies. The Evergrande collapse wasn't just about one company, it was about the dangers of unsustainable debt, the risks of regulatory policy changes, and how quickly financial contagion can spread in our interconnected global economy. The numbers tell the whole story. $300 billion in debt, 1.5 million affected customers, and ripple effects that touched markets from Shanghai to New York. It's a reminder that in the world of finance, what goes up on borrowed money can come down very, very hard. What do you think? Could a collapse like Evergrande happen in other markets? Let me know your thoughts in the comments below, and don't forget to subscribe for more deep dives into the financial stories shaping our world. Until next time, keep watching those numbers. They always tell the real story.